Welcome to the Explainer. Today, we are completely bypassing the small talk because we've got a massive, incredibly important problem to solve right here, right now. We are figuring out the absolute best UK stocks and shares ISA platform for 2026. If you're looking to build long-term wealth efficiently, well, you are in the exact right place. Let's get straight to work.
Okay, let's dive right into this. Across the UK right now, most people are quietly bleeding money. They're losing hundreds of pounds every single year. And the crazy part is, they don't even realize it's happening. They haven't fallen for a scam. They haven't necessarily made terrible investment choices. No, they are losing their wealth to fees. Picking the wrong platform is just this hidden wealth killer. It sits in the background, silently eating away at your future fortune. But today, we're going to fix that and make sure you actually keep the money you earn.
Part 1. Origin. Let's talk about the tax-free shield.
Think of a stocks and shares ISA less like an investment itself and more like a special container. It's basically a magical, tax-free wrapper that sits right around your investments. Inside this container, everything you earn, every bit of growth, every dividend payout, every ounce of profit is completely protected. HMRC cannot touch a single penny of it. It is entirely yours.
So, here is where the math gets very real. Without this ISA wrapper, if your investments grow, you could owe capital gains tax, and that currently sits at a massive 18 or 24%, depending on your income bracket. But with an ISA, that tax drops to zero. Nothing. It's completely tax-free. I mean, it's literally the difference between sharing a quarter of your hard-earned profits with the government or keeping every single penny working for your future.
And that brings us to the golden number, £20,000. This is the annual allowance that every single adult in the UK gets every tax year. But there's a massive catch here. This allowance resets every April. It does not roll over. It operates on a very strict, unapologetic use-it-or-lose-it basis. If you don't shield your money this year, that capacity is just gone forever.
Now, you might be wondering why choose a stocks and shares ISA over a standard cash ISA. Well, a cash ISA is safe, sure, but it grows at an absolute snail's pace. Over the last 30 years, if you put £1,000 in a safe cash ISA, you'd end up with maybe £1,800. But if you had invested that exact same $1,000 in a global index fund inside a stocks and shares ISA, that turns into roughly $17,000. It's a staggering, life-changing difference. Yes, stocks carry higher risk, but historically, their long-term power is just completely unmatched.
Moving on to Part 2, Invention Work. Let's compare the actual platform engines. First up on our workbench is Trading 212. You probably heard your friends talking about this one, and honestly, for good reason. It is completely fee-free for ISA accounts. No platform fees, no trading fees. You can literally open an account with just a single pound. The app itself is incredibly clean and slick, which makes it absolutely perfect for complete beginners with smaller amounts of cash. They even offer great interest on your uninvested money. The slight trade-off, the range of funds is a bit more limited, and some traditional investors might just prefer older heritage brands.
Next up is Vanguard. This name has absolute legendary status in the investing world. These are the people who practically invented the index fund. Their whole philosophy is just low-cost simplicity. Their platform fee is capped at a tiny 0.15% per year, and their funds, like the famous Global All Cap or the Life Strategy series, they automatically diversify your money across thousands of global companies. It is the ultimate simple set-and-forget engine. The catch here? You're strictly restricted to Vanguard's own funds, so no individual stocks or outside funds allowed.
Then we have the heavyweight, Hargreaves Lansdown, or HL. Established way back in 1981, this is the biggest, most trusted platform in the UK. This is your premium, full experience option. You get brilliant customer service, top-tier research tools, and you can hold almost any investment on earth. But, and this is a critical but, they are expensive. The fee is 0.45% per year on funds. Just to put that into perspective, on a £50,000 portfolio, you are paying £225 a year just to park your money there. That friction can seriously eat into your profits over time.
Sitting right in the sweet spot between those extremes is AJ Bell. This is kind of the perfect middle ground. You get a massively wide range of investment options, very similar to Hargreaves Lansdown, but their fees are significantly lower. And importantly, they're capped. Now, the app might not be quite as slick and modern as Trading 211, but it's highly functional, it's incredibly reliable, and it's absolutely fantastic for intermediate investors who want a lot of choice without paying that premium price tag.
Finally, let's look at Fidelity. Now, Fidelity is a brilliant piece of machinery if you are an experienced investor with a larger portfolio, think £50,000 and above. Why? Because they cap their maximum platform fee at just £90 per year for shares and ETFs. If you have a massive portfolio, this makes them one of the absolute cheapest options on the market. However, if your portfolio is under £25,000, their percentage-based fee structure actually makes them quite expensive compared to the others.
So how does this all build together into a complete picture? Let's cleanly map out all 5 engines. We've got Trading 211 for beginners seeking zero fees, Vanguard for the hands-off index investor, Hargreaves Lansdown for that premium, full experience, AJ Bell for the intermediate mid-range user, and Fidelity for large, cost-conscious portfolios. Take a quick second to think about where you might fit into this lineup.
All right, part 3, impact. It's time to pick your ideal platform.
This is the million-dollar question, or rather, I guess the 20,000-pound tax-free question. Which platform should you choose to start building wealth? Well, the answer isn't a simple one-size-fits-all. It completely depends on your unique situation, your experience level, and how much you actually have to invest. So let's match you up to your perfect platform.
Okay, if you are a complete beginner starting entirely from scratch with less than £10,000 to invest, your path is super clear and totally frictionless. Step 1, open a Trading 212 ISA. Step 2, buy a global index ETF, something like the iShares MSCI World. Step 3, set up a monthly direct debit. You want to keep it simple, keep it automated, enjoy those zero fees, and just let the market do the heavy lifting for you.
Now, what if you're the ultimate hands-off investor? You don't want to look at stock charts, you don't want to pick companies, you just want long-term growth with zero stress. Your steps are 1. Open Vanguard. 2. Pick a globally diversified fund like the FTSE Global All Cap or maybe a life strategy fund. And 3. Check it exactly once a year. Seriously, it's the gold standard for a disciplined, set-and-forget wealth-building strategy.
On the flip side, if you're sitting on a larger portfolio of £50,000 or more, the rules of gravity kind of shift. At these numbers, percentage-based fees become a massive drag on your wealth. You really need to run the numbers on Fidelity to take advantage of their strict fee caps. Or, if you truly need maximum flexibility and world-class research to manage that wealth, consider Hargreaves Lansdown. At this level, fee structures completely change the game.
But ultimately, you have to remember this absolutely crucial point. The best platform isn't necessarily the cheapest one. It's literally just the one you'll actually use. If a beautiful, engaging app on your phone gets you excited to invest consistently every single month, that psychological edge is worth infinitely more than saving 20 quid a year in tiny platform fees. Don't over-optimize to the point of paralysis. The habit of investing matters way more than the platform itself.
Which brings us to our final question to close out this explainer. You've got the map now, you know the engines, you understand the tax-free shield, so are you going to let another year of hidden fees, inflation, and overthinking just drain your wealth? Or will you pick your platform, lock in your ISA allowance, and start building your financial future today? The choice is entirely yours. Keep learning, keep investing, and go take action.